Right now, we want to talk more implications for the markets after that red-hot jobs number and what it could mean for the Fed and rates. We want to bring in Charmaine Mossavar-Rahmani, who is the head of the investment strategy group at Goldman Sachs. She's also Goldman's chief investment officer for consumer and wealth management. And Charmaine, let's just talk about this number. I mean, Larry Summers said that this may be the most difficult economy to read he's ever seen. I think you're in that camp.
Yes, we have been in that camp for quite some time. Our 2023 outlook, we actually called it caution, fog ahead, because we wanted to convey to our clients that there's a lot of uncertainty and nobody should position a portfolio with too much conviction. They shouldn't go from one extreme to the other, meaning don't assume that we're definitely going to have a recession and position a portfolio for a recession with an underweight in equities, but don't also position a portfolio for an overweight in equities, assuming that we're going to have just a soft landing. And so,
what
given
does that mean, though? If that's the constraints and trying to figure it out, how do you perfectly balance a portfolio, especially after a year where stocks and bonds both went down?
So the most important message to our clients is always to make sure they have the right strategic asset allocation. So nobody could have a view in terms of overweight or underweight if one doesn't know what neutral is. So for every client, there should be what is the right reference benchmark, how much stocks, how much bonds, for those who can have diversified portfolios, those who qualify for having alternative investments. The idea is you have to have a view of what neutral is. And in the face of so much uncertainty, with so much uncertainty about the probability of a recession, then one should be at that neutral position. So when you say, what does that mean? That means be at whatever neutral is at this point in time.
But it doesn't mean sell out or stay out of the markets for now.
Not at all. One of the most important investment themes that we've had since the trough of the global financial crisis is to stay invested. So we've had two themes, stay invested and U.S. preeminence. And even a year like last year, where we had both stocks and bonds go down, which is very rare.
I wished I sold at the beginning of last year.
On the other hand, unless you timed it perfectly, for most U.S. investors, the tax burden would have been far greater. So if you're a New York resident, New York City resident, California resident, in fact, the market didn't go down enough to make up for the taxes you would have to pay for the capital gains. So in fact, the idea...
Don't sell until you move?
So it's very important to factor in all of these taxes for taxpayers. That's why we say stay invested. And on average, something like last year only happens 2% of the time since 1926.
You mean with equities and bonds both down?
Well, it's very rare that both go down. And only 20% of the time since 1926 have you had a negative return for a stock bond portfolio. So it happens, but the portfolios tend to recover. On average, they recover between 8 to 10 months. And so the message to clients is nobody's going to time the market perfectly. No matter who we talk to, sometimes they'll get it right, sometimes they'll get it wrong. And so unless there's huge conviction that we're going to have a recession and the market hasn't already priced that recession, one shouldn't go underweight. And with a market high to low that was down about 25%, that's already been priced in.